Well, it's Jobs Day, and what better way to end the week than be talking to Andrew Grantham for his take on these potentially historic figures. So, Andrew, let's start at the end, shall we? 271,000 jobs added, blowing the 185k estimate out of the park. The market was listening, dollar has surged, yields up, borrowing prices down. Is it really as good as it seems? And are we looking at the data which has sealed the deal on a December rate hike?
Yeah, well, for Janet Yellen and other Fed officials that seem to have been itching to start hiking interest rates for some time now. This employment report, not just the jobs number 271,000, but also the sharp increase that we've seen in average earnings as well, 0.4% on the month, moving up to 2.5% year over year. These figures are pretty much as good as it gets for them. It really does boost their case, for some of those Fed officials who weren't decided and needed, further swaying. These figures really kind of support the case for a Fed lift-off in December. Of course, we've had some false starts before in terms of the data on earnings, and we do have another payrolls report to see before the Fed meets and decides on that December 16th date. But it does appear, given these strong figures that we've seen today, that date, December 16th, will be the day that we finally see interest rates in the US lift off that zero lower bound.
On that issue, Andrew, the whole point of QE was to move investors out of the risk curve. If everyone reverses a 7-year trade, how does that affect liquidity in the markets?
Well, and this is something that the Fed is certainly very worried about, and it has been laying the groundwork for some time that it's been telling investors, it's been telling the markets, okay, we want to move interest rates off of zero, but we are going to do this very gradually. It's going to be a very gradual increase in interest rates, and we've seen that even as we are getting towards that first hike by the Fed, longer-term interest rates and bond yields really haven't moved up too much yet. And so in that respect, it does look as if the Fed, via that communication that interest rates are going to stay historically low for a long period, it's going to be a very gradual path in terms of their hiking cycle. It does look as if the Fed's communication regarding that has, up to this stage at least, been pretty successful.
Okay, so let's not forget the rest of the news. China's 10-year sovereign bonds capped the biggest weekly drop in 5 months, amid signs the central bank is done cutting borrowing costs for now. Will profit-taking be the theme for the end of the year, or do you think the bank will cause market moves accidentally or on purpose?
So if they are done cutting interest rates for now, that may actually be a good sign that they think that the economy is now growing at a speed that they're comfortable with. And from a global perspective, from a global growth perspective, that could mean that there's better things to come in 2016.
Elsewhere, Greek Parliament has approved reforms needed to unlock €2 billion of bailout aid, but several measures still have to be agreed with creditors ahead of Monday's meeting of the Eurozone finance ministers. Analysts are saying the banks are on a wing and a race, but can they make it work? Do you think the Greek economy has turned a corner?
Well, if the Greek economy has turned a corner, it's still facing a pretty sizable slope, a pretty sizable mountain to climb around that corner. I think we have seen some signs that the situation there, has certainly improved from where we were a year or two ago. But in Europe, it does seem like growth is holding up pretty well. Peripheral countries are maybe starting to turn their economies around a little bit as well. And, we're hoping to see even better things next year.
Okay, so all of that digested. Next week, it's a turn for the UK and their jobs data, and EMs are likely to be interesting. But how do you see the dollar performing, and is its strength something to be feared?
Well, we have already seen signs this year that in terms of the manufacturing sector and, the capital spending that maybe goes along with that has been a weaker area of the US economy this year. So the US dollar, or the strength of the US dollar that we've seen previously, and if there's one area of the world, if there's one country in the world at the moment that can cope with a stronger currency, it is probably the US. its exports as a percentage of GDP is fairly low compared to most other developed economies. And its consumer there is, there's still quite a bit of pent-up demand in terms of consumer spending relative to the trend that we were seeing before the recession. We saw consumers, repaying debt during or just after the recessionary period and not really going out and spending as much as they were. And so lower import prices for consumer goods will help boost some of that consumer spending in volume terms, and that would be a driver for growth going forwards in the US. So we don't really see an acceleration or a deceleration in the US economy, but it's more of a shift in focus away from kind of manufacturing and capital spending towards the consumer and the housing market.
Well, will this good news be taken as such? The TV team will be back on Monday to find out. Thanks for watching and have a great weekend. Bye for now.